Hey traders, what's going on? Welcome back to another video. So in this video here is going to be the introduction to the little new series that I'm going to put out, where basically I'm going to go through and explain how I'm taking these high probability trades, these trades that we take on the 127, the 161, and we end up getting some pretty good risk rewards. We use the candles to the left and all those type of good stuff to just produce good risk rewards so we can keep the odds of success in trading on our favor. So there's a bunch of things that I want to go through, just exploring these 7 principles of trading and really the 7 major parts: the mentality, correspondence, vibration, polarity, and just really getting to go deep down and explain how these things work, where we're looking to get into the market, and where we're looking to get out, and all those type of things. So I just want to take an overview before we actually go deep into each section by itself. But I want to go through and just explain. So the mentality, all is mind, the universe is mental. But this aspect here, the first one, really just goes to show us that we need a plan. A plan is something that helps us keep the end in mind, know what we're actually looking for, knowing that we have a higher time frame target, or what we're actually looking for in the market. Are we using support and resistances? Are we using moving averages? Are we using daily pivots, or whatever the case? We need to have a plan in mind before anything else down here works. Okay, all comes from the mind, and this basically is a good explanation to show how I actually ended up creating a method where I can pinpoint these highs and these lows to basically just get some really crazy risk reward trades, and just compiling everything together. So we should also be taking in that the universe is mental, and in this case for here, we will go through and explain on this on life and in trading, but for this here, the universe is mental. The whole universe of trading is the market itself. So we need to understand that everything that everybody sees on the market is coming from themselves. It is their own perspective. It's the reason why we have so many different strategies and all these different things, because people always are going to see a bunch of different things in the market. Sometimes people will see the same thing, but it really varies from time frame, from method, a bunch of different things. There's many different variables to understand what you're actually going to see in the market, and will you be able to keep up with that, or whatever the case. We go more into that when we actually break down the mentality and building a solid plan for you to have, so you know what you're looking for, you know that's only what you're looking for, and you can actually keep a positive mental state when you go through these. So that's one thing as well, having the proper perspective on the market. And then we must also touch into the 5 psychological fears. If we're not aware of these fears, there's a good chance that we will land in these fears, and then they will just keep us from, they basically keep us from attaining any success with anything below, which these things below are going to be more on the actual methodology of trading, the actual style that we choose to trade from. And the mentality also goes in line with the emotions of the trader. Any trader of at least, let's say, 2 months can tell you that trading is a very emotional thing. So we have to be at a higher level than our emotions in this case here. We have to be aware of our emotions and understand how we're going to deal with them, and what emotions we need to stay away from, because that just goes into a whole cycle of negativity happening, right? And that whole type of stuff will just lead into revenge trading, and we know revenge trading is not something that is good. Okay, so next, the big aspect down here is correspondence. So like I said before, this very old saying, as above so below, so as below so above. Okay, so basically both of these things are inversed. This goes into a whole big detail. You will find that when I go through and just explain each one is very similar to the last one. Really, all of them are the one aspect of mentality divided into 7 different aspects, 7 different viewpoints of this one mentality, basically also of the one trading. We will go into looking at marketplaces as well, how marketplaces were built, what were the first marketplaces like in the world. So it's the aspect of correspondence here that is actually showing us that a lot of things are actually dual, as above so below. So a lot of things in life, the markets, they're actually dual. This whole aspect goes into actually supply and demand. We go through just to understand that we have orders, which is the fundamental principle of trading. Above are supports and resistances, and the same thing for the supports and resistance. There's orders above and below, and we go through just to identify them, to understand that there's opportunities there. There are average opportunities, and then there are exceptional opportunities. So same thing that we understand when we have a buyer and a seller into the market, you know that for every buyer there must be equal seller, because if you're buying, there must be someone who is willing to sell you this product or this stock or whatever the case may be. But there also has to be enough for you to buy. If you were to buy something, realistically what you do is you place an order, and then the order gets filled a few seconds later. Well, these days, a few seconds later. Back in the past, which we will explore as well, back in the past, filling an order sometimes took days, weeks, or months just to fill a small order or fill a very large order. Okay, so we understand that there's an aspect of supply and demand, and we have a positive aspect and we have a negative. So negative here and positive here. just understand that we have a polar high and a polar low. Same thing that goes in with polarity, same thing that will go in with gender when we look at it, and the same thing will go with rhythm when we look at that as well. Next one is just to understand vibration, and vibration goes into the actual market structure that we'll look at. What is the market structure telling us, and how to actually use this market structure to our advantage, top-down analysis, time frames. And one thing very important about the vibration is actually the normal vibrations that we'll get, let's say when price is in a consolidation, and then the extreme market structure or the extreme vibrations that we'll get sometime where price dips below and then goes back, or dips peaks above the resistance and it goes back below. So those are areas that we want to key in on for our entries and for everything just like that. If I can just scroll down real quick. Yeah, so things just like this where we look at for the low to get popped out below before price actually going back to the upside. Okay, and then we basically have something very similar for polarity, where we must understand that we have highs, we have lows, we have highs, we have lows, and we have these same highs and lows on period spectrums, on time frame periods of weekly, daily, monthly, 4 hour, 1 minute. They all produce their own respective highs and lows, which is something that we should look out for. And with these highs and lows, we also have extremes. We must also understand that everybody has a perspective in the market. This is a very important part down here where it's all truths are but half truths, all paradoxes may be reconciled. This, I'll go in more detail when we actually get to that topic, but this just goes to show us that it's actually a very important part that we need to look into with this as well, which we will when we get to that topic of polarity. But this, in a short gist, goes to just tell us that we may be wrong for a short period of time when we're trading the trend. Like we know we have uptrend market structure, but there's a time period where the market actually goes down. This ultimately gets reconciled if this is to be viewed as a paradox, something strange, or something that doesn't make sense. When a lot of people see this pull back and be like, okay, is it in a downtrend? Price is actually falling in this uptrend. This is something that later gets balanced out. We'll also look at that in cause and effect and rhythm, but nonetheless, everything always gets balanced out, and we just need to come to the understanding that the market is always going to be right. Sometimes you find traders saying that the market is not doing the right thing, it should be somewhere else, or whatever the case may be. We must understand that the market is always right, and if we find ourselves on the incorrect side of the market, it is because we are wrong, or there is a higher law at play, which we will touch on when we touch into rhythm, and cause and effect. One of the next important topics as we go down our list here is gender. We must understand that there's a male principle to everything and that there is a female principle to everything. I don't want to go too much in detail into it here, but we must understand that each gender is represented by a trend. If we can understand what gender is being represented in the trend, we can have a better time either finding opportunities or knowing that the market is actually trending right now and this is not the best time for buys. Better to take buys during the female concept while the market is making these wild wick areas where we can capitalize and get great risk rewards on. Same thing kind of goes for rhythm, where we basically have to understand that there is an aspect of time. We will go in more into detail, but we must understand that while we have, let's say, swings like this takes a certain time period. It normally takes equal to 3 times that amount to get back to the same area if we are continuing up to the upside. Don't believe me? Check your charts and back test it. We will do some back testing here later down as well. We'll do some back testing at the end of this whole series as well, so we will get a good gist of how everything works and what are the actual results. Next, last but not least, is cause and effect. The fundamental principle to trading is its investors and its reflection on price. I go through to explain what is the actual reason why price moves, understanding that it is market orders which moves price, not news, not anything that is not an actual effect on the market like investors. Investors place a market order and that creates activity for the market. News cannot create activity if no investors react to it. As we know, there is times when news gets released. If no one is there to really pick up on the news or act on that news, then there is no reaction of the news, simply enough. And that's all I really want to say for this video, guys, because we're going to jump in just right now and actually break all these things down into their really small details. Here we have these 7 principles. We have the one, the start, which is the marketplace. We're going to start off by looking at how marketplaces used to be run way back in the past. And actually the same principles that are still kept today, understanding that for there to be a buyer, there must be a seller and all these type of things. And then from this one, we then divide into 3. The 3 main branches of successful trading is going to be your mindset, really important, money management, because you can't go broke, and then methodology, because your plan must fit your personality to a degree that makes you comfortable and not worried, and something that you can actually perform on a habitual, repetitive basis. Next, from there, where we actually jump into the methodology and the details of actually taking our entries, we need to be looking into the perspective. What is our perspective on the market? where are the supply and demand, where are the market orders in the market, and where can we try to see our position being filled, where can we see a majority of traders lose their money, and then the other side of the market actually take their trades once the majority has lost. We need to pay attention to things like structure. Are we giving a dominant trend, or are we consolidating? What is the higher time frame doing? Does this match the lower time frame? Things like highs and lows, because I really want everyone to understand that way back in the past, when people did have access to stock prices, or I wouldn't say stock prices, but commodity prices, whether that's for corn, potatoes, whatever was traded in different areas, rice, or whatever the case, people did not get to update their charts every day, or people did not get to update their charts every hour. People really got to update their charts, whether it's once a month or once a week, whenever the person had come into town displaying all the prices. And one thing as well, all the prices were very outdated sometimes. So that is one thing that I really want us to look into, because we must understand that we can have good opportunities on trades, good probabilities on trades, just by getting the higher time frame view, which is what a lot of people of the past really depended on for their analysis. Old and sort of late market structure in the candles. Okay, next we have to just look at the trends. What is a trend? Is it uptrend, downtrend, consolidation? And how will we actually be able to move from this? Trends goes into there, highs and lows into polarity, time into rhythm, and then investors and price. Understand the cause and the effect of both of these. Price affects the investors, and investors affect the price, and both of them are effect of the counterpart. And then this, like I mentioned, goes into cause and effect. So yeah, we're gonna just break into this. I'll see you in the next video when we touch on the mentality, the mindset that you're gonna need to trade, and the perspectives, the 5 fears, the outlook, and everything that sets the rest into place into a way that you can do it. We'll also touch on money management, which I didn't mention here, but let's get to it. Thank you, traders, for checking out this video. I will see you in the next video below.